Hey everybody, this is Alex Merced from alexmerced.com. Again, this is another video where I wanted to kind of address a few sort of misconceptions about economics and finance. This one I want to talk about is just how people sort of view finance and the markets as a casino. And they say, basically they think that every dollar, like let's say you gave people tax cuts, all that money is going to go into financial derivatives, and not into businesses, which just is filled with not understanding of how money works. Bottom line is this, okay? It doesn't matter who gets that extra dollar. If a dollar is saved, let's say dollar is saved in a bank, okay? That bank may do several different things with it. It may lend it out to somebody for a house. It may lend it out to someone for a business, may lend it to somebody for a credit card, but it also may invest it in derivatives. Now, what are derivatives? This scary word. Derivatives just mean it's a product whose value is based on something else. There's varieties of derivatives. But most derivative products at the end of the day are insurance, okay, of some sort. If it's a credit default swap, you're buying insurance on a debt obligation you have. So investors who lend money are going to feel much more comfortable lending money when they can buy insurance on the loan, okay? Because when you're buying bonds in the market, that's what you're doing, you're lending money. Okay, using calls and put options, you can hedge stock positions you have, which means you're going to be much more comfortable buying stock. And the thing is, and the importance of being able to offset and manage risk means you're willing to commit more capital. So if I'm someone who is only comfortable committing, let's say, $100,000 of capital, but now that I can hedge and manage my risk, you might be able to be willing to commit $1 million. That's an extra $900,000 that's available to businesses, etc. Okay, so again, those derivatives offering an ability to offset risk, and yes, oftentimes, and the thing is that those products need liquidity, because I may want to be able to buy insurance, but I also may want to be able to get rid of my insurance if I don't need it anymore. So it's people who speculate, people who are really literally just gambling in the market, but they're providing a service. One, they're expressing their opinion. So they're helping us kind of figure out what the right value of a stock is, what the right value is. But they're also providing liquidity. They're providing someone I can buy these insurance contracts from. Because basically, if I buy a credit default swap, someone has to be the other side who's going to pay me if my debt obligation breaks, if my bond dies. So someone else is going to take the other side of that bet, who doesn't think of like Geico. Aren't you glad you can buy car insurance? That if someone crashes your car, there's someone who's going to pay you a big chunk of money to cover your expenses? That's essentially what the other side of most derivatives are. Someone, if your thing breaks, they're going to pay you a bunch of money. Okay? But they're hoping that doesn't happen so that way they can keep the money you've given them so far. But again, because you can get car insurance, you're more willing to drive. You're going to be much more comfortable. You're not worried about, losing your everything because you drove to the movies. Okay, and that allows you to be much more economically active. Same thing with derivatives. Allows a lot of investors to be more economically active and put much more of their capital to work. Okay, at the end of the day, any billionaire, millionaire, there's only so much money they can use to spend in a year, consume. Okay, but even that's not necessarily bad, because there's some patron on the other side. I mean, if you are an artist or a musician or someone in the fine arts, chances are the reason why you're able to do full-time what you do is because you have very wealthy patrons who patron the fine arts. But, okay, even better is the money that they don't spend, that they don't consume, because that's the money that goes to the capital markets, and it gets managed by money managers who are trying to identify what business ideas make sense and try to figure out ways to get people who have business ideas the financing that they need. Okay, now, is it all perfect? Not by a long shot, because there is a lot of distortions in incentives. Okay, this is why a lot of libertarians and free market types like myself talk about distortions of interest rates, distortions in regulations that make certain businesses suddenly look better than others than they naturally would, so capital moves differently, or tax rules that make one business idea suddenly make more sense than a business idea that actually would be more productive because of the tax incentives. But that doesn't necessarily mean the money isn't going somewhere. It's still going to seek a return. Now, there are things that drive more risk-taking. Okay, now, here's the name of the game. And again, not all investors are risk takers. There's risk takers, people who are just looking to park their money and make a little bit of money, okay, which is actually most capital. And then there's those who do want to try to, roll the dice a little bit. And then there's those in several shades in between. Now, here's the thing. More risk, more reward. Now, here's the thing. If you reduce my reward, how can I offset that? By taking more risk. So, for example, let's say I have a 10% return and you tax me at 35%. I now only have a 6.5% return. Let's say the economy has a decent amount of inflation and you have an additional 2% of inflation that year. So now my 6.5% return after taxes really is only a 4.5% real return because of the lost purchasing power. So that 10% of money that I made has really not gotten me as far ahead as I thought. So if you tax me more, how do I make up for it? I got to take more risk to get a higher return, or potentially a higher return. And if there's more inflation, what do I have to do? I have to take more risk to offset that reduction to my return. So the more, and the other way you impose costs is through regulation. If you regulate more, companies are going to make less. And if they make less, I'm going to be like, you know what, that company versus this company that makes more, I'm going to put my money here, and that's going to make it harder for this industry to attract capital. Okay, which means that industry will not develop as fast. Okay, or what oftentimes happens, these really regulated industries, then they have to sit there and manipulate like intellectual property, because the only way they can make up for all the red tape around them is to have some really long lasting patent to cover all those costs. Okay, because they can extract enough profits, and then you just get into all this rigmarole, and it just kind of feeds itself. Okay, if you had a much lower, flatter tax code, people would just invest in the companies that just make more sense. Okay, the companies wouldn't have to be that profitable to make sense as an investment. Okay, because here's the thing. Let's say, again, let's take a look. Let's take 35%. So if it's let's say 3%, 30% taxes. So if I have 5%, if a company makes 5% a year, okay, with a 30% tax rate, okay, that means you're going to be taking about 1.5%. So I'm going to be making about 3.5% after taxes. Now, let's say you reduce those taxes to 10. So right now I'm making 3.5% after taxes, and let's pretend that's a suitable amount for me. Well, now let's say you got rid of those taxes, got rid of the income tax, just to be hypothetical about it. Now a company that's only making 3.5% will be suitable to me, because since they're not taking out, because it'll be making me about as much as I was making before. I was okay with that. And now companies that are not, industries that are not as profitable now suddenly make more sense. They're able to thrive, they're able to get capital and be able to survive. So these are all things we need to think about when we're thinking about these things. There's so much to say.